Now, many of us who are investors of Chinese companies have a common fundamental assumption. That is, we believe that China's growth and prosperity is not stopping anytime soon. In fact, those growth and expansion will continue growing. This growth and expansion will inevitably have a trickle-down effect, benefiting both companies and the people by and large in the entire economy. Of course, I understand that having a strong economy, reporting monstrous growth quarter after quarter, does not directly translate to a stock market rally. However, in order for markets to rally, a key driver is that the growth and performance of the underlying business behind every single ticker symbol should be outperforming. Investors ain't dumb. People place their bets on companies that achieve a certain hurdle rate, or ROI in this case. And in return for risking their monies, they ought to be rewarded handsomely. No pain, no gain. Therefore, the prerequisite for businesses to do well, at least in China, is that the economy by and large should continue prospering and must continue prospering due to their limited reach on the international stage. A recent meeting just last Monday between Chinese Premier Li Keqiang and 10 local government heads showed that Beijing is currently on high alert posture. This change in policy posture was primarily driven by the headwinds of the Chinese economy. The central government also actually promised a new round of supportive measures for smaller companies to protect jobs and to protect growth. This sends out a threatening signal to both businesses and investors because unlike the rest of the world, China is attempting to create a dystopian world. The government generally have a high degree of control and is largely aware of the developments internally, at least in their own country. The latest move by government officials come hot on heels of warnings by several government advisors that the country's economic recovery is not yet all stable. You know what else is not stable? The rate of you smashing the like button. So try to make it a 100% hit rate from now on by turning it blue. Now, China's third quarter GDP grew a disappointing 4.9% as industrial activities rose less than expected in September. It essentially missed expectations for a 5.2% expansion. The GDP growth in the fourth quarter is widely expected to fall below the key threshold of 4%. So Li Keqiang actually cited a few reasons, such as unstable and uncertain factors, both at home and overseas, are increasing the China's economy in facing new downward pressure factors. So, Li Keqiang actually urged local governments to take on more actions to support small businesses and make them a major economic priority, such as offering more tax cuts and helping them with payments in arrears. So now, SMEs are usually the backbone of any single economy out there, even though we like to believe that those big tech firms usually bring loads of value to society by and large and employs a boatload amount of people. However, the threshold and criteria for working, especially in these big tech firms, remains relatively steep by proportion. Hence, it is your local factories, your local supermarkets, and your small medium enterprises in the supporting industry that employs the most amount of headcount. So, small firms accounted for around 80% of the nation's non-government employment at the end of 2019. President Xi also stressed in July the importance of reducing monopolistic practices among big firms to essentially allow SMEs to flourish in the long run. Now you know why Alibaba got hit by a truck. China's smaller companies account for about 80% of the country's urban jobs and about 60% of the entire GDP. They are widely seen as a major pillar supporting increased incomes and rising domestic private consumption under Beijing's new dual circulation strategy. So, Li Keqiang also emphasized the government's focus on ensuring security in employment, people's livelihoods, and the market entities, which was odd because such phrases are usually used only when supporting the economy with policies amidst the pandemic. Now, China has definitely proved its resilience to the world in 2020, where they were the only major economy that still pulled off a positive yearly GDP growth, while the rest of us were still clowning around and trying to open up, lockdown, open up, lockdown. However, the sector has taken a hit from rising raw material prices amid the supply chain issues caused by repeated outbreaks all over the world. So, they have also been hit by a series of regulatory crackdowns and by a nationwide power crunch. So, some of you might be scratching your head. Isn't the regulatory crackdown the initiative from the highest office of government? After slapping your own businesses, now you're trying to do damage control. What are you even trying to do? Are you out of your mind? So, to make things worse, the power crunch was a byproduct of the heightened tension between China and Australia, which was also a deliberate action by the party itself. So what are they trying to achieve here? To cut the long story short, the regulations were a necessary evil. I think as foreign investors, we always forget that China is still in the stage of a developing nation. Many protocols and many regulations are still in the germination stage, and I would dare argue in a very early stage. We love to compare them to the US counterparts and draw the simple conclusion that, hey, the West can do it, why can't you? It's like saying the US has a winter season, why can't Singapore have snow too? Maybe that's how they created Snow City. But anyway, we have to take into consideration the nuances of the country and their status of development. Every country is running their own race, and they have a boatload of internal issues that they have to attend to and iron out with all the different stakeholders. An additional pair of eyes playing the role of a vigilante surely do not help alleviate the local government's burden. Regulations that transpired throughout the entire crackdown do show pronounced cracks and loopholes in the existing system. And it is a normal tendency for businesses to exploit the shit out of broken systems, and you know it as well as I do. We are wired like that, don't ask me why. So this constant tug of war between the government and businesses has to maintain at a healthy equilibrium. China has nothing to gain, but everything to lose if all the regulations they did the past year was just to flex the government's capabilities and the government's muscle. That will truly make them a government full of clowns, because it was totally pointless. Like I always say, look at the things from both sides of the coin. Don't just blindly believe what journalists have to say. They are exploiting the mere fact that they have the ability to string words together and crafted a narrative they wish to feed the normal layman. It's disgusting at best. Anyway, the rise in cost due to higher import prices alone was expected to reach around 1.4 trillion yuan this year, whereas the total amount of tax cuts and help given to SMEs amounts to only about 700 billion. Hence, the top officials are currently urging county-level support to help alleviate the pressures for individual businesses and to stay away from a simple one-size-fits-all strategy, which will inevitably cause many businesses to fall through the cracks, as we have seen. So, the State Council, which is also the country's cabinet, also issued a plan to strengthen the relief efforts to support the SMEs in China. The document encourages local authorities to allocate relief funds for SMEs to ease their cost burdens when it comes to rent and utility bills, with subsidies to offset the rising cost of raw materials, logistics, and wages. It also said a wider financing guarantees will be offered to smaller companies. So rumors also has it, by smashing the like button, your social credit score will essentially go up and you can actually score a higher financing guarantee. You didn't hear it from me firsthand. So, Xu Xiaolan, which is the Vice Minister of Industry and Information Tech, said that Chinese economies will be good only if SMEs are good, and we should earnestly help SMEs to get through their difficulties and accelerate raising their competitiveness. The same philosophy also works for huge conglomerates too. Speaking to you, Alibaba, focus on broadening your value proposition, increasing competitiveness, and addressing the demands of your customers. Lastly, Li Keqiang also added that the country would make efforts to ensure a better supply of energy and electricity, push reforms and opening up, advance industrialization and urbanization, and continue regular pandemic control measures. So these recent developments of China will probably be a non-issue in the long run. The overall trajectory and story remains tightly intact, and this would probably just be a blip in the grander scheme of things. Not sure if you have seen what the success looks like meme before. It will never be a straight line, and as long as the people in the executive level knows what exactly they are doing, knows what is the strategy, and stays true to the values and vision, we are definitely in very good hands. Side note, which is also why I'm extremely anxious when people pitch to me their investment ideas, telling me that X company will do a 50, 60 or 70% growth for the next 5 years, and their valuation is worth it because our underlying assumptions are already considered conservative at 50%. Expecting for a flawless execution is something we can hope for, but never forget to prepare for the worst. With that, the China growth story seems to have just started picking up speed. We are far, extremely far from our goal. The only tail end risk we have today is that the people in governance suddenly takes a 180-degree U-turn and decides to screw with the country in their own private capacity. That will truly be the start of their downfall. With that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!